One, 1, 2. Check me out right here, yo. You can turn the track up a little bit for me. All up in my ears. The mic is loud, but the music ain't loud. Yeah. Yeah. Now the mic is low now. Turn the mic up a little bit. My shit's all the way up. Yeah. The music is loud. Kind of stocking though. That's what I'm talking about. I just want to wild out.
Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, May 20th, 2022. The S&P 500 currently sitting at 3816. I'm David Zarling. Ian McMillan and Kevin Ferrari are off today. Well-deserved time off, whether it's a vacation for Ian or enjoying that new home purchase for Kevin. I'm here with Dan, 8-minute splits, Gorkuber. Big race tomorrow, Dan.
Yeah, big race tomorrow. Finally get to the hay's in the barn, so good to see you. We can 26 miles worth, huh?
Okay, 26 miles. You probably should go just a little bit beyond 26.
Right, just a little bit.
Just a little bit. It would be tough to just stop at 26.
That would not be a finished race.
But I know everyone here at Client First is cheering you on, and now that our listeners know, they're going to be cheering you on. So blessings on that tomorrow. That'll be a lot of fun. And speaking of running, we're seeing supply run away with this market currently. S&P 500, like I mentioned, at 38, now 15, selling off. And now we have an S&P 500 that's down 20%, which is some fun round number that someone picked to declare a bear market.
Yeah.
And we've been talking about a correction before this, that we're in a correction, we're in a downtrend. I don't know that labeling something down 20% as a bear market helps anyone. I don't know. You have any thoughts on that, or, what we've seen this week? There's lots to cover. We had a little bit of indecision last week.
Yeah, no, the 20%, I think, like you said, just more of that round number feel, that retail probably likes to, I think a lot of it's driven from the retail side, right? A lot of their job is to sell and make things sound round and good, and round number, styles tend to fit with a lot of people. So,
you're talking about like financial news, like,
yeah,
they're watching their favorite network, and
yeah,
all of a sudden the 20% round number gets thrown out there, and now we're in a bear market, even though we had all sorts of information before this that we were in a bear market.
Yeah, I mean, even looking at just, breadth, still abysmal. You'll still have, you probably heard us countless of times on the pod here, you get one day that looks like, maybe breadth can start to improve, at least on like a thrust type of atmosphere. But really, we haven't seen it on a sustained period other than, one day at a time here and there. It's almost like we've seen more, downward type of thrusts.
Right. So what Dan's referencing here, if you're unfamiliar with it as a client, breath. So not breath as in exhale.
Which I'll be doing a lot of tomorrow.
Yes, you will. That's awesome. It's breath with a D right before the T. And it's really about participation. What we're seeing from a participation. And I know that I believe it was last week, there was a 90% update, meaning 90% of stocks, if you were looking at something like the S&P 500, 90% of them were up, which can have positive characteristics if it has follow through. And we saw quite the opposite. I believe it was this week, we recorded almost an 88% down day. So it negated any benefit that came from a potential breath thrust, basically throwing that out the window. And so, yeah, the breadth has been lackluster.
Yeah, it really has been. I mean, and like even, this week, now you're starting to see, the market come after, some of your more defensive, quote unquote style defensive type of, whether it be sectors or names. You take something like staples. I mean, staples are down, consumer staple sector, just using a ticker like XLP is down 9.5% this week.
Yeah. Well, and
That's not a great thing to see.
No, yeah. And staples being, and we've talked about this on the podcast before. So if you've got a defensive sector like staples and it's underperforming, but it's underperforming as it's moving to the upside, that's okay. That's a quality characteristic, right? That's what we want to see in risk on type environments. Now, where it gets problematic is when you see it outperform, but it's happening in an environment that's in a downtrend, and then they sell staples.
Yes.
It can be the final sell, though, meaning this is where asset managers start to sell everything.
Yeah.
And we get back to that. Are we correlation of one, meaning all asset classes or the majority of stocks heading in the same direction, in this case, to the downside? I mean, do you have some examples of stocks that we saw that were holding up well that they went after this week that
to the
downside?
Costco, Costco, talk about like a bellwether name in Costco, just had made.
Who doesn't like going to Costco?
Exactly. Right. I mean, it's literally Americans thrive in Costco.
And I heard a rumor that they maybe the sell-off in Costco is because they raised the prices on their dogs, man, their hot dogs. I heard a rumor.
Is that right? Oh, wow.
I mean, that sounds like
that's a big deal. Those hot dogs are good too.
They are, but I'm guessing it was just overwhelming supply.
Yeah, right. That'd be the thought. And I mean, like a name like that just made new highs April 7th, new all-time closing highs April 7th, and now here we are, May 20th, and
we're down 32%.
Yeah, almost back down to some of those 2020 highs. So,
and that goes back to risk, right? So that when we study the material for chartered market technician material, meaning the curriculum for it, one of the things that's identified in there is single stock risk, right? It's why the industry talks about diversification. Like you need to own a basket of stocks because you can have a quality name like Costco within a matter of, what are we looking at here? Just over 2 weeks, drop 32%.
Unreal. Yeah. Just exact. Yeah.
And so, and I'm not, that's not me advocating for diversification. That's actually me advocating for when Costco has a false breakout and it's back below 569 on the price chart, maybe just not be involved with it. Respect what's called a false breakout, because from false moves come fast moves. And that's what we're seeing. We're seeing in a lot of things. It's not just Costco.
Target, Walmart. I mean,
yeah, it's amazing. It's impressive. False breakouts in Walmart. And what I mean by, let me paint the picture of false breakout. Let's use Walmart, ticker WMT.
Yeah.
Had touched the 153 level in November of 2020, touched around that level in August 21, same in November 21, subsequently sold off, but price came back there and finally cleared it in April, around early April of this year. We call that a breakout. It's going on to new highs, and that can be very bullish. But if you don't have a risk management process for that, meaning back below 153, let's not be involved with it. That could have been a risk management process to implement, and it would have saved you a lot of pain, which we're now experiencing in Walmart. Walmart from that breakout down to here is minus 27, 26%.
Yeah. And I think that's it. Like, I think you said it awesome there for our clients and whatnot. And, we don't know, like nobody knows something like this is going to occur where we just fall off the face of the earth. Right. Or at least what it seems like. But like you said, you have that risk parameter in place where we start to hit those numbers, where we start to take out critical levels that we want to see hold, scenario analysis, right? Of if that, then this type of situation. And, obviously that doesn't occur. It doesn't, again, point towards just an absolute sell-off in and of itself, but it does tell us that, hey, we need to be taking some risk off in this case and looking elsewhere. So
Yeah, for sure. And so we saw Costco, we saw Walmart. I know you brought up internally Target, and there's plenty other names that had been safe havens that are still struggling. Like, I think of a sector that the team has been very good about identifying that it's holding up well is like shipping.
yeah.
But you look at shipping, and the pieces that have held up well there is something like, I believe it's Starbulk is a shipping name. SBLK is the ticker. And is that experiencing a false breakout now? So are you seeing one of the leaders?
Great point.
You've got, it's kind of like watching the best team in the league. So they're doing really well. The rest of the league is floundering, but the other teams just behind it start to lose their quarterbacks. Let's use football. And then all of a sudden you have the shipping team lose their quarterback potentially here in something like Starbulk Carriers. I'm not saying that's what's happening. I'm just saying it's on false breakout alert. Starbulk doesn't need to be something we need to own if it's below its prior highs. Let's call it 31.78. Again, everyone listening to this is an adult. That's not a recommendation. I'm just saying the theme of this market has been false breakouts, which you don't see in bull markets. You know, you look at, I think of copper as an example of another false breakout. And so it's not just exclusive to equities.
And deciding, yeah, exactly. And like, to side note on copper, even, I mean, does that kind of like following the false breakout, right, that you're talking about, just using, copper futures, I guess. Right?
Sure.
You get this down move, and now we kind of have what looks like to be more of a counter trend bear flag, bear pennant maybe coming in.
Yeah. Can you try to paint the picture of a bear flag for people and what that means?
Yeah. So, in general terms, if you think about just go out to your post office, right, and you look at the flagpole with the American flag on it, right? You have the pole and then the flag coming out the side at the top, right? Now put that image on a chart form, right, and basically just flip it over. So like the flag is on the bottom side, and your pole in this case would be pointing down. That's what we're really seeing out of. Yeah, at least as of right now.
And these have a propensity to mark pause periods in the continuation of a trend. They don't have to. The beauty of compression like this, or pennants or flags, is if they break the opposite direction of a trend, that's tremendous information.
Yes.
If we were to clear, like, let's call it 4 spot 40 on copper futures, that would be a positive development to the upside.
Absolutely.
But if we're breaking below the top of the flagpole, or what would be called the bottom of the flagpole, 4 spot 06 on copper, a little problematic.
And that's a big level. Yeah. That $4.06, $4 level, that's a big level there.
Yeah. That goes way back to another flag, another pennant that developed February of 2021 through April of 2021 that did break higher, but then subsequently it did reach its measured target if you're a technician.
Yes.
But then subsequently has gone nowhere. I mean, we're at the same price in copper futures as we were in February of 21. So it hasn't really gone anywhere, but everywhere during that time frame. And it's something that we like to look at copper because it's a economically sensitive asset. And it also had going back to the false breakout, we're seeing this. We've been talking about weak breath for a long time, since February and March of 2021. So we've been in this correction. Many stocks are past that 20% bear market number. It just so happens that the S&P reached that today. And do the broad indices follow to the downside? I think that's really dictated by the big cap names.
Yeah. And we've just seen them get absolutely hammered here lately. Really.
Can you walk through some of those?
Absolutely. Yeah. Well, again, if you've been kind of a listener of the show, a couple of big ones that we've been really hitting on are Apple and Microsoft, right? Apple below 150 was a big red flag. You get, kind of the cautionary red flag, and then you get the kind of the counter trend trade back into it, and continues to see sell off. We want to see, like you said, those all stars performing well, and right now we're just not seeing that from Apple. Microsoft being another one. Microsoft holding up a little bit better, relatively speaking, I think is what is kind of the gist that we're seeing. But again, below that 273, 275 zone, that we really needed it to hold in. And now you're talking challenging, some highs from early 2021 and late 2020 that we want to see hold up there. Obviously,
Sure.
like, some of the Amazons, the Googles, Amazon's been struggling, for quite some time as well. Actually, probably more closer to some longer term support in Amazon right now. So that'll be kind of interesting to watch, play out here right around like that 2000 to 2035 zone. So,
Well, we should just blindly buy that, right?
not necessarily, no.
Okay. All right. We might get cut up if we're trying to catch falling knives.
Exactly. Yeah. I mean, especially from our vantage point, right? Like we want to almost see somebody else step in first, and then, a bigger player step in first, get somewhat of a trend,
Right.
forming, right?
See some demand first, see a floor first. I know floor is a popular term in the crypto universe, or I should say NFT universe, which I think is a misnomer. It's an unfortunate wording, but Amazon's down 43%, almost 44%, right? It's a deal. We should be buying it. Well, maybe, or you're just going to see it fall even further. And so you have to have a process for identifying, is there enough demand in the market to see the price of Amazon stock stabilize, and then we can participate in it, is your point. There's no need to rush in and grab something that's dropped 44% in a matter of months when there's nothing saying it can't fall further.
Absolutely. Yeah. And that's the thing, is as long as we're coming into the market, which we are here at Adaptive and Client First, from a, tactical, adaptive approach each and every day, right? We can afford to be like that and say, hey, we want to see this, prove it to us. We don't need to be, that first mover in.
Right.
At all.
And let's think like a chef when we go to the grocery store. If the grapes are on sale, that might be great, but maybe we should look at the grapes. Maybe they're moldy.
Right.
Right. And just low prices don't equal a good deal. That's my main point. You get what you pay for, and the downtrends that are going on. If you want to buy those things, it may turn you into a really long-term investor, meaning like you got to wait like 30 years for these things to come back. That's not what I'm saying about Amazon. But there's many stocks that could be in that scenario that we've seen, whether it's IPO stocks, SPACs, some of these more tremendously speculative areas that we've seen discounted 50, 60, 70%. And it's and from time to time, I hear people comment, yeah, I'm buying here because it's low. Well, what's low?
Surreal. Yeah, exactly. There's
zero is low. So that's an option too. So Dan, if we cut up the market into slices like a loaf of bread, and we've got these different sectors of the market, what are we seeing? If we were to slice the loaf of the market according to size. So you have this, as an example, the thickest slice in the loaf of the S&P 500 is technology stocks.
Yep.
What are we looking on that? If you could walk through some of the sectors and what we're seeing, you could talk about the past week. You could whatever comes to your mind. What are we seeing on a sector by sector, slice by slice basis out of the market right now?
Yeah, I mean, well, just from this week, like you said, the tech sector holds roughly about 26.5% of the S&P 500, just using like the SPY.
So think about that. You're looking at a loaf of bread, and there's one slice that's 25%. It's a quarter of the whole loaf. Anyway, very important slice.
Driver. Yeah. We call that the driver, right?
Yeah.
And then, following up though, you do have that healthcare financial sector right behind, which, important nonetheless, right? As far as wanting to see those trends being healthy, and we
And what is
just
that, like
haven't seen.
14 or 15%, somewhere in
Yeah,
there?
15,
Weighting.
like just under 15 on healthcare, and
So
then
healthcare is
financials
the
right
next
around 11.
biggest slice. And if we use something like XLV, kind of important area here.
Oh man, yeah. I mean, talk about it needs to prove itself here. What would you call probably like this 125 area?
Yeah, 125. If XLV, which is a very nice ETF that represents the healthcare sector, loses 125, that's another big slice that's getting moldy and making the whole loaf unedible.
Yeah. And another one of those, like example, that's a great, recent example of tying back like that, the false breakout
Yeah.
situation, right? Just another example where April 8th, new highs, and here we sit right back in the range.
Mm-hmm.
And so we're going to need to see that.
How about the next biggest slice, financials? What are we seeing there?
XLF, nothing too great there either. I will say, let's see, it's down about 3% on the week. So yeah, it's hanging out probably in the middle of the rest of these sectors on the week at least. But certainly not, a lot of overhead supply there. You're probably talking, what do we say, like 31 to about that 20, 29 level is an area that's very, I hate saying assuming things, but that's a level from about 31 to 29 that looks very probable
Right.
for XLF. Right?
Well, and I'm being facetious here, but I'm kind of confused, Dan, because financials are down since the beginning of January 22%, but you look at 10-year rates and we've gone from 1.7 to 2.7, about a 63% increase. How come I thought the narrative was financials higher if rates are higher?
Yeah, well, when you have, there's environments in the market, right, that without getting too detailed into it, when you have these environments where we're basically, the life of a bull market is rotation, right? Rotation from sector to sector. Well, conversely, the life of a bear market is just the same to some degree. You see rotations within sectors. It's just more aggressive and rotating to the downside between different sectors.
Mm-hmm.
And in financials, in this case, with the rate environment, a little later, we'll probably talk a little bit about like credit spreads and whatnot, but correlations don't always have to equal each other in different environments.
Right. The wonderful thing about markets is there a lot like the planet around us. There's no such thing as every day is the same. Maybe in San Diego, California with the weather, but beyond that,
nice.
Everywhere else has 4 seasons, and man, you got fluctuations, and it's the same thing. You have to take. We're fond of saying you got to take each chart on its own merit, and don't marry your viewpoint of two different things. Like, don't overthink the dollar. Don't overthink rates. Don't overthink relationships, because relationships break all the time. And another example of that would be, right, we just talked about the S&P 500 touching a 20% correction today from a high to a low. The risk parity trade, the 60-40 portfolio, was built to potentially offset that, right? So when we think about the COVID panic crash, that's what I like to call it, the panic crash, is you look at the move from February 2020 to its high, treasuries actually appreciated 20% during that crash, maybe even a little bit more. And the market, so using something like S&P 500, corrected 35%. So market down 35%, treasuries up 20%. This market environment, extremely different.
Yeah.
Because since the beginning of January, we just said that S&P 500 is down 20% and treasuries are down 20%. So both are down 20%. That's different. That's a different market environment.
Exactly. And that's I think the biggest thing is to go along with it is the, correlations work until they don't. And, even, as I look at a TLT chart right now, you have that kind of a false breakout, right, of early December. to kind
Oh,
of
yeah.
lead the charge,
Yeah.
lower, with the rest of the market kind of following suit later on here. TLT obviously at an important level right now, just like yields are at an important level, pretty decent inflection point.
Yeah.
Um,
Could you walk through, when you say important levels, could you walk through TLT, the 10-year and the 30-year, and kind of just important levels and why? Like, you could just look left and kind of tell us the
yeah,
dates and.
yep, exactly. Yeah, as I look left, just looking even at like a weekly chart here for TLT, you have kind of that support shelf, at least as of right now, right around like that 113 to like 115 level. You've had some decent inflection points, dating back to late 2018, some 2014 inflection points in there as well. That kind of stand out, right? As technicians, we're always looking left to manage our risk. So those are some levels that are of importance there. Now, when we go to like the 30-year yield, not surprisingly, right? We're testing some of those levels again from a date perspective, November 2018, those highs from November 2018, right around like that 340, 330 on the 30-year yield there.
Yeah. So we're
but within
seeing
an uptrend, right? Within an uptrend on yields.
Yep. And so we have an environment where the 60/40 portfolio is quote unquote not working. And we can say that definitively because the data shows that bonds have not worked in the opposite direction as equities in this current correction. Now, we've also talked in the past that we've got two numbers, 60 and 40, they add up to 100, which leaves no room for commodities, which is unfortunate because we believe that every portfolio should have a room for commodities if appropriate at the time.
Yeah.
What are we seeing out of the commodity space in this environment currently?
Yeah, we're still seeing some good signs, like some healthy signs, I would say. I think we've lost some of like that powerful momentum, even from like a relative strength standpoint, but we're still seeing like healthy consolidation out of soybeans. Wheat just broke out here of a very tight consolidation, I believe, over the past week. Crude oil hanging in. When we talk like commodities, it's basically been in this range now from about 115 down to about 94-ish for much of the spring and into these early summer months now. So, seeing some healthy consolidation there, and really just trying to be tactical in our approach there for the commodities sector.
So Dan, would you say is it fair to say that, when we look at equities, that we've seen a thinning, right? We talk about breadth, but if we just look sector by sector, energy's held up the best. It's kind of like the last player out there. In the commodity space, it's kind of the same thing that we've seen, because we just talked about copper failing. There's been other commodities that have failed as well. And so we're kind of in a select few. Is that a fair?
That is very fair. Yes.
And the select few are associated either with grains or energy?
Pretty much. Yep. Very much so. I mean, metals have struggled, right? When we talk about like a 60/40 portfolio in the past, you'd think, okay, if the market's falling over, you'd expect bonds to help you. Well, that didn't work. Hey, maybe like gold and precious metals will help us. Well, that's not really helping you either in this type of market where you have the inflation narrative, looming and continues to loom for a couple of years now. And, really what has gold done from a precious metal standpoint?
Right. Exactly. So we've talked equities, commodities, some credit, some bonds. Let's talk a little bit about crypto assets, as I like to call them, not necessarily cryptocurrencies, which I'm sure ruffles feathers somewhere. Doesn't bother me. So we talked about Luna last week, Luna being the third largest crypto asset that corrected 99%, basically done, which, some would, if you think about the third largest stock in the S&P 500 almost going to zero, probably going to be a problem. Here we have, the next two largest are Bitcoin and Ethereum. What are we seeing out of those two crypto assets?
Bitcoin specifically is at a very key inflection point right around this, call it 29 to 30,000 mark.
Right, because that's a
But
level that goes back all the way to 2021, January 2021. Buyers have
yeah,
shown up there in the past.
yeah.
And if we don't see that hold, as we
It's
like to
not,
say, no bueno.
no bueno is right. Yeah, not good there. I mean, you have a lot of open field, a lot of open space below when we look at like respective levels that, below that we could think, maybe it pauses at or tries to reach. I mean, you basically have an open ticket to, well, 19,500 is really those recent highs from the breakout. But before that, I mean, we got to see this consolidation. We consolidated pretty heavily here in Bitcoin this week. What we're trying to figure out is, do you have, kind of going back to that flag, bear flag, bull flag situation from earlier, is do we have a bull flag going on here or a bear flag? I think it kind of depends on the time frame in Bitcoin, but probably
Right.
Go ahead.
No, exactly. I think that these are at extremely important levels. The two largest players in the crypto asset space at extremely important levels going into this weekend. And that's a 24/7 market, right? Open 24 hours a day, 7 days a week. That's a whole nother podcast, probably, because I know some people that would love to see equities do the same thing, be 24/7. And there's some of that with the futures market. I'm torn on that. We won't go there. But I do know that the person who was heavily involved with founding Ethereum this week came out and said that, maybe we should have insurance for, like, similar to FDIC, that's for bank accounts, right? A $250,000 per person insurance on their bank account for crypto, which is interesting, right? Because it was always supposed to be, crypto was always supposed to be this unregulated space that was for the people. And I'm going to go somewhere here. I'm going to kind of maybe go off on a tangent, but this goes back to, what is your worldview on people? Are they inherently good or are they inherently not? And I go down the route of inherently not. And this is why regulations exist. I'm not asking for more regulations. In fact, I don't like regulations, but I understand why they exist. They exist because it's trying to create some rules for the game playing board, right? When you play Monopoly, there's rules.
Yeah,
and
you gotta, yeah.
Go ahead.
No, and it's just funny that that was the big sell on, right? All this crypto space was decentralized.
Well, and don't words matter? like decentralized, but yet here we're finding out there's a few, so it's more centralized than it is decentralized.
Exactly.
And stable coins are actually unstable, right? Because Terra, the one associated, the quote unquote stable coin, like, listen to that, like the marketing term, the term used for that was called stable coin. And here you had massive wealth evaporated in something that was supposed to be stable, absolutely the opposite thing. And so we have a whole market environment where we're using terms like decentralized for things that are actually centralized. We're using terms like stable when it's actually unstable. And I'm not here to hate, because I think there's a future here. I think there's a future for blockchain type technology. I think there's a future for crypto assets and tokenization and NFTs, non-fungible tokens. I think there's definitely something here.
Yeah.
But to act like it's immune and it's Teflon and it's untouchable, and you don't think the rules of greed and fear and supply and demand don't apply to these things, is naive. And I think we're going to learn some things here in the coming months about fear and greed and pain and joy and those things that come out of innovation, because this is innovative and I think it's fantastic. But with innovation comes pain.
Yeah.
And to me, and again, I realized I went off on a little diatribe there, but this was the moment I felt was appropriate to point out that words have meaning. You don't get to just say something's decentralized when it's actually centralized, and you don't get to say something stable when it's actually unstable. We need to start being careful with the words we use, whether it's, in our relationships or in markets. Like, words have meaning.
Well, yeah. And like we were kind of talking earlier off air here, was that, I mean, you look at the world now, and I don't mean to get on a diatribe either, but you just look at, like, the norm is hypocrisy.
Right.
That just seems to be the norm now, and it's not good.
Right. Well, and these are characteristics we see in bubbles. And what I mean by that is the .com bubble. There were companies slapping .com on the back of their name, and they might not even had a commerce website that they could sell you anything.
Yeah.
So it actually wasn't anything .commerce or .com. It was a company that was taking, and this is human nature. You take things to an extreme, and it's not coming from we do this, I do this myself. I'm not preaching from a soapbox. I do these same things in my life, embellishing and making things, making a mountain out of a molehill all the time. And so we just need to be careful as market participants on the words we use to describe investments, because there's real people involved. And what I would hate to see is real people hurt really bad financially by this, that they then turn on the innovation and say, crypto's garbage, blockchain is garbage. That's not the case. It's typically things aren't as good as they are, and they're not as bad as they are. It's somewhere in the middle. And that's where I believe we are in the crypto space. 30,000 in Bitcoin needs to hold. You look at something like Ethereum at a critical level, close to 1750, that needs to hold. Yeah. So we've covered equities, bonds, commodities, crypto. We even went on a tangent about
good stuff.
Words having meaning. Anything else you kind of want to touch base on in this portion of the podcast before we go to the extended portion, we get a little more in the weeds?
No, it was great little discussion there on kind of some higher level, even outside market thinkings. And, if we have clients or anybody that wants to reach out and continue the conversation, I'd welcome it. So
yeah, absolutely. We've had great conversations this week about risk management, that bonds don't fix everything and they're not the answer to everything. However, we can get excited for retirees that if interest rates continue to rise, that we can use that type of environment to get some stable yield for our clients. That'd be fantastic. So with that, in the extended portion, we're going to talk a little bit about credit spreads and treasuries a little bit more, as well as some areas that we'd like to see hold up and where they're at. So we hope you guys stay on. Otherwise, if you're signing off, Dan, just want to wish you well in your race. And I want to thank all the listeners for tuning in, and we'll be back next week.
Yeah, thank you, everybody. Have a great weekend.
All right, Dan, heading into the extended portion of the podcast, we talked treasuries and rates a little bit. I know last week, Ian and I talked a little bit about credit spreads. Any thoughts on what we're seeing from a credit spread or credit environment perspective that you want to touch base on?
Yeah, there's a couple of things, right? Like really kind of seeing the environment of similarity. A lot of similarities, even not just in the credit spread environment, outside of that as well, but specific to this couple minutes here with credit spreads, is that we are seeing some similarities with that 99, 2000 through 2003 type of environment where, you're seeing those gradual uptrends where many times in the past, right, you look at like a recency, going to use recency bias, for example, of 2020, where we saw credit spreads really just out of nowhere, skyrocket from more of a risk perspective there. In this case scenario, and like I was kind of trying to allude to, is that we're seeing that gradual uptrend take place in these spreads, similar to what we saw in 99 through 2003. The triple B spreads, corporate index option adjusted spreads, really this week just made a new high relative to the middle of March high there. So we technically have a continued uptrend now in that spread taking shape, right?
So we're seeing that out of triple C's. You're here talking about the tranches, triple B. So it's middle ground. It's not the trash. It's middle ground. And even like last week, I think we talked about liquids. So your investment grade, which should be somewhere high B's, low A's, somewhere in there.
Yeah. And A's aren't far behind on the triple A's aren't far behind on that.
Right. So we're and this would be an environment of tightening liquidity. And so you brought up before that rotation is the lifeblood of markets, and it can happen to the downside too. I would throw liquidity in that same bucket as far as ample liquidity, great for markets, contracting
Absolutely.
liquidity, not so great. And when we see these credit spreads moving higher, this is indicative of market environments where liquidity is drying up. And that's what we've been seeing. I mean, whether you look across the board, bonds, stocks selling off,
You name it, really. Yeah.
everything's matching up. And this goes back to how many podcasts ago where we talked about market cycles and seeing that stocks and bonds going down together with commodities moving higher typically is the final stage. And if we start to see commodities moving downwards, that would be the first stage of a bear.
That's the clue. That could be a clue.
And I still go back to any counter trend rally at this point, using something like the S&P 500, and we talked about this in the past, we could absolutely rally to 4,100, 4,175 and roll back over, and it doesn't fix anything.
Absolutely.
And at this point, that type of rally is about 10%, just under 10%, around 9%. And it would feel amazing. And but that doesn't mean it's something we should be involved in.
Right. And that's,
Go ahead.
Yeah. And that's the beauty of coming into the market every day and being able to say, okay, what's, for us at least, right. And from our technical side and just being adaptive, saying, okay, do we want to have more of a risk on or risk off approach here today? And really what has the market been, really speaking to us on is, there's been some tactical, positional, like a risk reward plays that, that we've taken to the upside. But overall it's been quite the struggle in terms of trying to find healthy, broad uptrend type of narratives. So.
Yeah, absolutely. Totally agree. And moves now are in the need to be considered counter trend.
Yeah.
And counter trend in this scenario is we're in a downtrend. So counter trend would mean prices move higher without necessarily fixing anything. Now, this is one of the more bearish podcasts that we've done. Now, we've been bearish for a while, and people who watched our January Lunch and Learn or listened to the podcast for a while understand that we've been bearish for a while.
Yeah.
Let's challenge our minds and our listeners a little bit. What are some potential positives? What are some things that we could look at from an evidence perspective and say, that's interesting. Maybe that's the first sign of some type of bottoming process. Anything in you that or anything to you that sticks out in that?
Well, I'm going to take a more of a broad approach and just kind of come back to the breadth perspective.
Okay.
And just say, we kind of had it in the blog. I think it was was it a week or so ago? We had the blog post, and it's been a whirlwind of a calendar date here, but where we talked about breadth and not only what is the current breadth space, what is the here and now in breadth, but then what do we want to see from breadth going forward to kind of, answer the question you just asked of saying, what do we want to see? What does it look like? And, thus far we haven't seen that. We need to see some thrusty days out of really just, advances minus declines type of volume. That would be a start. We also would like to see, in the form of a bottoming process, it would be nice to see just the percent of stocks over certain moving averages, right? Start to increase. We've seen kind of the bottom drop out on a lot of those names getting hit that are below certain moving averages. I'm talking 50, 100, 200 day moving averages. If we can start to see some of that thrusty type behavior from there, that's going to be evidence that something might be trying to turn around here. And again, thus far we haven't seen that.
Right. We'd love to see those hard hit areas firm up. And I would say that, whether we're looking at smaller software using something like PSJ, some of those ARC funds did show some relative strength this week and broke out on relative basis out of tiny bases.
Yeah.
meaning like on a daily time frame. So that's a one potential positive, and we would want to see that continue. In this environment, the hard part is you can see those areas rebound and counter trend. And I know we covered it last week to see, you could see ARC move 50 to 80% and it doesn't fix anything. And so we're in the throes of a primary downtrend, and the counter trend moves will be vicious and they will feel great. That's why we call them relief rallies, because you're relieved, but it doesn't necessarily fix anything.
Right.
We need to see credit spreads cool off, liquidity enter back into the system, and
Dollar kind of maybe roll over.
yeah, I was
Or
just hoping. I was just about to bring up the dollar because it was the one thing we hadn't talked about yet. And the dollar, using a trade weighted dollar, using Dixie DXY, 104, kind of a critical area that had broken out of. Is this another false breakout potential in the dollar in a range that goes back to 2014? Are we going to see that fail? I think that's definitely TBD, because it originally broke out, but it's currently holding 103.19 in the current moment. If that moves higher, that will definitely be a headwind for a lot of things. But you could see that pull back into the range, and could be actually, and I can't remember if I said headwind, but I meant to say headwind previously. If that fails, though, it will become a tailwind for various areas, but we'll see.
Yes. Well, I think even just too, like you mentioned some like the PSJs, some software in there, and like semiconductors, I know is another one we've been really, watching quite closely to see, just trying to, is there some relative, strength even within this downturn, right? Because that's still a clue at the end of the day. If and when this thing were to turn around, can we start to see relative strength kind of be that first indicator mover, if you want to say. And I think it's probably TBD on that as well, just to see if they can round out somewhat of a relative structure there or not.
So Dan, you're a little bit of our resident expert on the alphabet soup of time decay and optionality. When we look at an instrument like the volatility index, the CBOE, which is intricately linked to that, what are we seeing out of something like the VIX in this environment? We kind of alluded to the 99 to 2003 environment, which we saw elevated VIX the whole time.
Yeah.
Where are we at now?
Well, right now, /VX. So it's going to, again, your CBOE volatility index, your VIX futures off the June contract. And then, we're sitting right around that 30 level, very compressed right now. If you do, for the chartists at home on other platforms, VIX can give you the same type of analysis as well, right? But, just look at that from a daily perspective, very compressed towards the upper end of this range, right? Like this 35 to 36 zone on VIX. Very important from a upside level, that if we're going to continue to see fear potentially in this market and really push, we would probably see, that VIX above that 35, 36 zone. But I think too, like you were saying, is just looking at that 2000, 2001, 02, 03, I mean, very, very similar type compressions, took place in that VIX market with a dragged out, sell-off in the overall market there. So it's just kind of an environmental thing, right, that we want to be aware of. We're always looking left. It doesn't mean it has to copy everything, but it's certainly something that we want to be aware of.
Yeah, and it's interesting because another thing that I know some managers and whether it's retail or institution are looking for is this capitulation event, which would mean just the throwing the baby out with the bathwater, where just a high volume event where just massive selling across everything, which we did get with the COVID panic crash.
Yeah.
And maybe potentially looking for that now, where we would see the VIX probably snap higher, anywhere from 40s into the 70s on a measurement basis, which would be impressive. And probably would mark capitulation at that point. That would probably mark
Yeah.
some type of intermediate low, not necessarily the low, right? Because people are used to, well, dude, we touched 78, 80 in the VIX during the panic crash. And if we touch that again, we're just going to rally continuously from there. No, because if people remember during the COVID panic, the topic du jour then was, are we going to get a retest? My guess is that
True.
recency bias will have people convinced it's just another V bottom.
Yeah, and you definitely have to be careful with that recency bias, no doubt. And that's maybe, you know, on that capitulation piece too, of kind of looking at something we've been looking at this week is, you know, certain names or sectors relative to like last week's low, right? Where our indices, you know, a lot of our indices like SPX is below last week's low. Your NASDAQ, of course, below last week's low. But there are certain other like individual names and sectors that have yet to kind of reach last week's low.
Mm-hmm.
So that's kind of something to take note of too when if the indices are, the question would be, are the indices, you know, in the driver's seat now, or are they going to be the ones that's kind of like that capitulation type of piece we're talking about, right?
Right. Well, I think at this time it would be appropriate then to talk about, we like to look at markets with mile markers or significant markers. When you look at charts, a lot of them show kind of the same characteristic. One area I think about is January 2018. That is a mile marker for many markets. That's Volmageddon. That's when we had all sorts of issues with volatility products, and you had corrections across the board. There was a price response, capitulation price response that you can identify in a chart, almost every chart, January 2018. A similar mile marker is the period of August 2020 through November 2020, where you had a pretty violent consolidation. And using something like the Qs, I'm talking about a range that's excess of 10%. And when you look at charts across the globe, using something like the Qs as an example, we're in there now. We're all the way back to the levels we saw in August and September of 2020. So over a year ago, that was the first consolidation off of a rampant move off of the COVID lows. Now, on the flip side, that consolidation on the S&P, the middle of it is around 3380, which also matches up with the COVID, the pre-crash highs, the February 2020 highs.
Yeah.
And so as you're listening to this, you're going to need to pull up a chart to understand what I'm covering here. My point being that the Qs have already gotten there. IWM has not gotten there, and S&P has not gotten there. But if the S&P is going to get there, it's going to have to involve more than just tech. And that's where the chart you talked about before with healthcare, XLV, if we see XLV join the party below 125 to the downside, we're probably hastening this process, meaning we're making this correction back down even faster, right? Because that's the second largest sector. Because we already have tech breaking down. And we have Apple and Microsoft confirming now. That's probably the next sector we see break if we're correcting down into that mile marker area. So I felt the need to highlight that.
Well,
Go ahead.
Even taking, you know, another sector like discretionary when we were noting, I mean, that's below that range now.
Yes. So you're saying using something like XLY is actually through it, and that's been the leader to the downside.
Yes. So that's very interesting as well, you know.
Yeah, for sure. Absolutely.
Something to be note of, I guess.
When we think about tech and we talked about Apple and Microsoft before, one thing that I would think investors would want to look at is, can we get Apple back above 139, right? Which maybe we do that today. You know, we're an hour and a half away from close. If we get it back above there today, that would be a substantial event. That would be positive for a bounce or some type of move that breaks this down cycle. But for now, the evidence continues to be, and we're going to wrap up here shortly, Dan, the evidence continues to be a downtrend, and we don't need to be involved with trying to catch falling knives at this point.
Yeah,
so
definitely,
with that,
definitely not.
We've covered a lot of ground. Anything you want to touch base on before we wrap this up?
No, it's been a pleasure being on this week. But another great week of, like you always say, managing risk for clients. And I just, want to give the thoughts to everybody of it's very refreshing coming in, being adapted to market conditions each and every day. Obviously, we were talking earlier. We're very fortunate we get to come in and manage, these markets and help our clients each and every day, and we're very fortunate for that. So we thank everybody, and thanks for listening this week.
Yeah, absolutely. We appreciate everybody. As our clients know, cash is a position too. And we hope everybody has a great weekend ahead. Dan, hope you have a great race. Can't wait to hear all about it. And everybody listening, we'll be back next week.
Have a great weekend, everybody.